You are sitting in a dark room, staring at your phone. You have just bought two different stocks. Almost immediately, stock A jumps 10%. Your heart rate ticks up, and an overwhelming urge kicks in. You need to sell it right now. You want to lock in that win before it vanishes. But further down the screen, stock B drops 20%. Instead of cutting your losses, you freeze. You tell yourself it is just a temporary dip. You hold on to it, absolutely convinced it will bounce back. This is a chart tracking investor behavior. Notice how the probability of selling sharply spikes on the profit side, but completely flattens out on the losing side. In behavioral finance, this well-documented pattern of selling winners early and riding losers into the ground is called the dispossession effect. This behavior directly contradicts classical economics. The old models assume you and I are purely rational actors, perfectly calculating every move to maximize our total wealth. By letting the winners go early and holding on to the losers until they hit bottom, we actively destroy our own returns. Our brains are forcing us to make bad trades. In the late 20th century, psychologist Daniel Kahneman challenged those traditional economic models by proving that human decision-making is heavily influenced by irrational biases. He and his research partner, Amos Tversky, developed an alternative framework called prospect theory to map exactly how we make choices under conditions of uncertainty. This graph illustrates loss aversion. The psychological pain of losing $100 is twice as intense as the pleasure of gaining that same amount. We measure outcomes relative to a specific reference point, usually whatever we started with. This schemed perception causes us to become highly risk-averse when protecting a gain. But when we try to escape a loss, we suddenly become dangerously risk-seeking. Financial choices aren't driven by mathematical logic. They are driven by a biological imperative to minimize emotional pain. In this diagram of the brain's neural pathways, the LPFC handles slow, rational planning and cognitive control. But the lower affect section houses the amygdala, which drives automatic, fast-processed emotional and fear responses. When your portfolio drops, the amygdala detects that loss as an immediate danger. It floods your brain with stress signals that physically weaken and override the logical prefrontal cortex. In this highly compromised state, a rapidly falling portfolio triggers a raw physiological panic attack, identical to a primal survival reflex. This neurobiological glitch ripples outward from the individual trader to skew the entire global financial system. This paper by Shlomo Benartzi and Richard Thaler explores myopic loss aversion. It investigates what happens when loss-averse investors evaluate portfolios too frequently, seeking to explain the equity premium puzzle, why stocks vastly outperform safe treasury bills, yet investors avoid them. Benartzi and Baylor found that the constant, short-term checking of portfolios exposes investors to frequent micro-losses. The daily pain of seeing those red numbers scares them away from the highly lucrative long-term equity market. The extreme accessibility of modern financial data actually weaponizes our biology against us. The closer we watch our money, the less of it we keep. We cannot rewire millions of years of evolutionary survival instincts to suddenly be good at trading stocks. Psychologists suggest workarounds like hedonic framing. This involves tricking your brain by mentally viewing your portfolio not as a series of daily wins and losses, but as abstract progress toward a singular, distant goal. But mental tricks fail under the stress of a market crash. To survive those moments, investors require systemic firewalls, like robo-advisors, to remove the human element entirely. Look at this diagram outlining bias mitigation mechanisms. At the top is algorithmic discipline. Automated platforms bypass the amygdala completely by executing predefined investment strategies. Scanning downward, we see foundational tools like personalized nudges and goal-based frameworks. They do this through automatic portfolio rebalancing. By periodically adjusting your assets to maintain a predefined risk profile, the algorithm structurally forces the portfolio to sell high and buy low. It physically prevents the human urge to market time or panic sell. These platforms also use behavioral nudges. By framing performance in probabilities and sending goal-oriented notifications, they proactively calm the investor's emotional response during a downturn. long-term wealth accumulation relies on engineering strict, automated systems that insulate your capital from your own biology.